Welcome. We are now in the second topic of financial accounting, CPA foundational level. We are in the second topic of financial accounting, CPA foundation level. And the second topic is called recording transaction. This is a very important topic in financial accounting. The topic of recording transaction, if you understand it very correctly, it will help you throughout your study in this unit of financial accounting. In this unit, we are going to read about journals. Journals are also called the books of original entry. Then we are going to read about source document and examples of source document. And then we are going to finish with the journals and their format. So journals and their format. And before that, you can kindly subscribe. And if you subscribe, I'm giving summarized financial accounting notes and answers to customer past papers question from 2015 to 2023 to help you in preparation or revision of financial accounting ahead of us. So we start with journals or the books of original entry. At journals, the definition of journals is very simple. Journals is the first place in the business where a transaction is formally recorded in a chronological order. So journals or books of original entry is the first place that business transactions are formally recorded in a chronological order or in order of dates at which a transaction took place from source document. So a journal is just a book where the transaction is initially recorded from source document. So it does not matter whether that book is a physical book or it is a computerized book, as long as it is the first place where a transaction is recorded, then that is a journal. And that transaction is recorded from source document. So what are source document? And we say that source document, we are now in number 2. Source documents are documents that contain the details of a transaction. So, source documents are documents that contain the details of a transaction. They are either received by an organization or produced within an organization. For example, if a business makes a sale, then the sales invoice is a source document. If a business make purchases, then the purchase invoice is a source document. So journals they derive their information from source document. So we can go and now see some of the examples of source document. So examples of source document. And the first example of source document, we have quotations. What are quotations? Quotations, they are documents produced within an organization and used to let a potential customer know the cost of goods or services before they decided to purchase. So quotations are simply documents that an organization prepare, and they send those documents to potential customer so that the customer can go through the quotation. They can read about the quality of good. They can read about the prices of good, and they can read about the means by which those goods will be delivered, so that those potential customers are able to decide uh, whether to purchase the good or not. So quotations are documents produced within an organization and used to let potential customer know the cost of goods or services before they decide to purchase them. Then the next source document is purchase order. And purchase order, it is a document issued by a buyer to a seller indicating types, quantities, and agreed prices for product or services that the seller will provide to the buyer. So after you have said a quotation to a customer, if the customer decide to buy your goods, or if the customer decide that he wants your services, then he's going to send you a purchase order indicating I want these goods, I want this quantity, and the agreed prices of the product or services that you are going to sell to that customer. So this purchase order is sent. Uh, so this purchase order is issued by the buyer or the customer to the seller to indicate the quantity they want, the agreed prices for the product or services that the seller will deliver to the buyer. Then we go to the next source document. It is the statement of account. And statement of account, it is a record of transaction that have occurred to a customer account during a specified period of time. If you go to a company and the company have a lot of customers, then they maintain a statement for each customer to show that this customer A uh, have purchased this amount of good and he have paid for this amount of goods. So the company or the business keep a statement for each customers to show the transaction that have occurred to the customer's account during a specified period of time. Then we go to the next source document, which is remittance advice, and it is a letter sent by a customer to a supplier to inform the supplier that their invoice has been paid. If the good have been delivered to the customer and the customer pays for those goods, then he is going to send a remittance advice to the supplier to inform the supplier that he have paid for the delivered goods or services. Then we have receipts, and receipt it is a document raised by the firm and issued to the customer or debtors when they make payment in form of check or cash. If you go even to a shop and you pay for the goods, then you're given a receipt. So the definition of a receipt is very simple. It is that document that you are given after you pay for your goods or services. Either whether you pay by cash or check, then you're given that receipt. So that is all about the receipt. Then we go to the next source document, which is petty cash voucher, and it is a small form used to document a payment from a petty cash fund. So you find that in businesses or in companies, they usually maintain a petty fund. So if a payment has occurred from a petty fund, they are usually they, yeah, usually small sums of money. They usually small sum of money. Then if a payment occur from the petty fund, then uh, a petty cash voucher is issued. Then we go to the next source document, which is sales invoice. And it is a document released by a firm to communicate to clients about the sum that are due in exchange for goods that has been sold. So if the firm make a sale, then it raises a sales invoice to inform the client or the buyer about the amount of money that that buyers now owes to the business or to the seller or to the supplier. So that is sales invoice. So if a sales occur, then they issue a sales invoice. Then we have purchase invoice. It is the document produced by the creditor and sent to the firm when the firm make a credit purchase. So if the firm now goes to the supplier or the creditor and make a purchase, then that supplier or the creditor uh, will issue a purchase invoice. They will issue a purchase invoice when the business now make a credit purchase. Then we go to credit note, and also here in sales invoice, mostly they are issued when clients buy goods on credit basis. Then we go to the next source document, which is credit note, and it is a document raised by the firm and issued to the debtor when the debtor returns some goods back to the firm. You may find that a debtors usually have the trade receivables. Debtor is a person, then the trade receivables is the amount that they owe to the business. So if the debtor has purchased goods on credit, and for any reason they are not satisfied with those goods, maybe those goods are not of the quality they expected, maybe those goods have gone bad, maybe the prices of those goods is very high and it is not satisfactory to those debtors, or for any other reason they decide to return the good that they have purchased on credit, they decide to return them to the firm, then the firm is going to issue them with a credit note. Then we have the debit note, and it is a document raised by the creditor and issued to the firm when the firm returns some goods to the creditor. So when we come to the debit note now the business have purchased from suppliers or the creditors, and the business decide to return some goods because of reasons like maybe those goods are not of good quality, maybe they have gone bad, or for any other reason they decide to return those goods, then the creditor or the supplier is going to issue the business with a debit note. The creditor or supplier is going to issue the business or the firm with a debit note. Then we go to the bank statement. And the bank statement it is a summary of financial transactions which have occurred over a given period on bank account held by a person or business with financial institution. So bank statement is simply if you have a bank account, if you have a bank account and the statement they maintain, that is a bank statement, and that statement usually shows the financial transaction that have occurred over a given period of time. Now we are through with source document. We are through with source document, and we said that uh, journals journals or book of original entry is the first place where transactions are recorded in a chronological order, and those journals or the books of original entry, the information that is recorded there is usually obtained from the source document. And we have discussed the source document. We have given the examples such as bank statement, debit note, credit note, purchase invoice, remittance advice, and so on and so on. So, so now we look at these journals now. I'd give some examples. I'd give the examples of journals. And we say that there are two types of journals. There are two types of journals. One, we have special journals, and then we have general journals. And we say that special journals are used to record special types of transactions such as sales and purchases, to avoid tedious work of recording repetitive transactions in general journal. So, special journals are all journals apart from general journal. So, all journals are special apart from general journal. All journals or book of original entry are special apart from general journals. And we say that general journals, they are journals in which now the special kind of transaction cannot be recorded. So We see which are these special journals we are talking about. Examples of special journals. The first examples is a sales journal. And a sales journal, it is the book of original entry in which credit sales are recorded. Mark the word credit sales. So sales journal is a book of original entry in which credit sales are recorded. Uh, Let me put this one in bold. So sales journal, it is used to record credit sales. Then we go to the purchases journal. It is used to record credit purchases. So purchase journal is where credit purchases are recorded. Mark the word credit. Then we go to the sales return journal, and it is used to record returns from debtors and our allowances of goods sold on credit. So if there are any goods that are returned by the debtors, then those goods, the amount of those goods is recorded in the sales return journal. Then we go to the purchases return journal. So it is used to record returns on to creditors. Now if the business returns some goods to the if the business now returns some good to the creditors or the supplier, then that amount is recorded in the purchases return journal. So here you note that sales return journal, let's go to the sales return journal. We have discussed about a document called credit note. And we have said that credit note is a document raised by the firm and issued to the debtor when the debtor returns some goods back to the firm. So it therefore means that the source document for the sales return journal, the source document for the sales return journal is the credit note. The source document is now the credit note because the credit note is issued to the debtor when the debtor returns some good back to the firm. And now when we come here to the purchases return journal, you've said it is used to record returns to the creditor. So we can say that the debit note is now the source document for the purchase return journal. Then the final example of a special journal is the cash book. It is the cash book, and cash book is used to record all the cash transaction. If a business receives cash, it is recorded in the cash book. If the business make payment, they are recorded in the cash book. So you can find that the cash book, it is used to record receipt and payment of money by business in cash or through bank account. And there are three types of cash book. Number one, we have a two-column cash book. We are going to see the format for the two-column cash book. We have a three-column cash book. We are going to see the format for the three-column cash book. And finally, we have petty cash book. We are also going to see the format for the petty cash book. Therefore, we start with the format for the sales journal. And sales journal, the format of a sales journal is indicated here. So you first record, you indicate the title, you say that is a sales journal. You record the dates, details for you. This is the for your number of a transaction, and then you record the amount of the transaction. For example, we are going to do an example in the next lesson. Then you go to purchases journal. So this is the book where credit purchases are recorded. So you record the date of the transaction, the details of the transaction, what has been purchased, then the for you number, and then the amount of the transaction. Then the sales return journal, you record the date of the transaction, the credit note number. We have said that that credit note is issued when the debtors return some goods to the firm or to the company or to the business. So you indicate the credit note number, then the details of the goods which have been returned for your number, and then the amount. Then we have the purchases return journal. Also, it is the format is the same. You indicate the date, the debit note number, the details for the for your number, and then the amount. Then you have the two column cash book, and in the two column cash book, it have two sides. We have the side of the receipt. This is the side of the receipt, and then this one is the side of the payment. So it have the date, details, cash, and bank. So if a payment has been made through cash, you're going to write the date, the details. No, if a payment has received, if cash has been sorry, so if cash has been received by the business, you are going to indicate the date at which that cash was received, the details, what that cash was received from where, then you indicate the amount. Then if cash was received through the bank or there was a check which was received, then you indicate the date, the details, and then the amount which was received. So this side is for the amount received by the business. Then this side, now from here, it is for the amount which is paid by the business. If the business pay for maybe for expenses or for anything which is related to the business, then you indicate the date of that payment, the details, and then the amount. If the business pays through the bank account or through a check, you also indicate the dates, details, and then you indicate the amount here on the bank. So that is how this is the format of the A2 column cash book. Then we go to the format of a 3 column cash book, and a 3 column cash book just look like the 2 column cash book, except that the 3 column cash book has it has discount. So on the receipt side, you have the discount allowed, and on the payment side, you have the discount received. So discount allowed occurs when if the business or the firm purchases good from supplier and the supplier choose to give the business some discount, that is called discount. No, we are saying that discount allowed occurs when we so we are saying that discount allowed occurs when the business gives a discount to the customer. So sorry. Discount allowed occurs when the business gives a discount to the customer. And then discount received occurs when the business is given the discount by the supplier of the good or the creditor. So that is the discount received. So discount received occurs when the business is purchasing, and then discount allowed occurs when the business is selling. So uh, we have said that the difference between a 2 column cash book and 3 column cash book is the inclusion of discount allowed at the discount received in the 3 column cash book. And finally, we have the petty cash book. The petty cash book. Remember, that businesses, they usually maintain a petty cash. So here on this side you have the amount which is received from the business. So the allowance for the petty cash for that period, that is the amount which is received from the business. Now from the business itself, now this is the amount which is going to be maintained as a petty cash. Then we have the date of the date at which that petty cash was replenished. Then we have the details, and then we have the payment amount. So for example, if the business pays for cleaning expenses from petty cash, then the amount is recorded here. If the business pay for maybe motor vehicle expenses from petty cash, you record the date, and then you record the amount here and here. Also for cleaning expenses, you record it here and here also. And if the business pay for postage expenses, you record them. Stationery expenses, you record them. Traveling expenses, any payment that is made from the petty cash, it is recorded here. And on the receipt side, you record the amount that is replenished, the amount by which the petty cash is replenished. Thank you very much. I'll see you in the next lesson where we might do some examples.